If someone in your town owned 3 to 5 different businesses, let's say a bakery, a laundromat, a car wash, you'd probably say, wow, that person really knows how to diversify. They've got multiple income streams, different customer bases, and they're not tied to just one industry. But strangely, when we talk about investing in the stock market, people suddenly think you need to own 20, 30, even 50 different companies just to play it safe. Where does that idea come from? And more importantly, does it actually make sense? Let's dig into a classic discussion where Warren Buffett and Charlie Munger explain what they really think about diversification, and why most people have it all wrong. Mike, a question from the audience. A man named Mark from Scottsdale, Arizona, stands up during a Berkshire Hathaway meeting and asks Warren a thoughtful question. Warren, I've read through your shareholder letters and noticed that over the years, the number of stocks you hold has varied quite a bit. In some years, like 1987, you only had 3 main stock holdings. So here's my question. Does the number of stocks you hold today reflect how you view the market's value overall? And second, it seems like whenever you make a new investment, it's usually at least 5% of the portfolio, but never more than 10%. Is that a rule you follow? Speech balloon. Warren Buffett's response. Warren starts by correcting the assumption that Berkshire always sticks to a strict 5 to 10% range. He explains that not all of Berkshire's investments are listed in the public reports. Only the large ones, those over $600 million, are visible. There are many smaller positions that the public never sees. Sometimes those smaller investments are because the businesses themselves are small. Other times, the stock price may have gone up after they bought in. And in some cases, they might be in the middle of exiting a position. So no, there's no hard rule. But the real takeaway came when Warren started talking about diversification. Diversification, as it's commonly practiced, makes very little sense if you know what you're doing. It's a protection against ignorance. In other words, if you don't know how to evaluate businesses, sure, buying 30 or 40 different stocks can protect you from disaster. You are essentially saying, I don't know what I'm doing, so let me spread out my bets. There's nothing wrong with that approach. In fact, index funds are a great option for most people. But if you do understand how to value businesses, then spreading your money across 30 mediocre ideas is actually worse than putting more money into your best ideas. If you find one wonderful business, why would you water that down by buying your 30th best idea instead of adding more to the one you already know is great? Magnifying glass the reality. There aren't 50 great businesses. Buffett points out a hard truth. There simply aren't that many incredible businesses in the world. Maybe you can find 5, 10, if you're lucky. But 50? That's fantasy. Most truly great fortunes in America weren't built by owning a little bit of everything, they were built by owning a lot of one great thing. Think about it. The Mars family got rich from candy and pet food. Sam Walton built Walmart, just one business. Jeff Bezos built Amazon. Coca-Cola created more millionaires than most people realize. These aren't people who owned slices of 40 companies. They went deep on one thing they knew well. 3 amazing businesses that are easy to understand and well protected from competition will outperform 50 average ones, and they'll be safer too. Warren emphasizes that he would personally feel safer owning 3 outstanding companies than owning 50 stocks picked from a popular index. Brain Charlie Munger's brutal honesty on finance education. At this point, Buffett turns to his longtime business partner and friend, Charlie Munger. Charlie, in classic Munger style, cuts right to the point. Most of what's taught in modern finance classes is just twaddle. Audience laughs and applauds. He goes on to criticize modern portfolio theory, the academic approach that says you should own lots of different assets to reduce risk. Charlie thinks it's completely overhyped. It's filled with fancy Greek letters and math that makes it sound sophisticated, But all it really does is show you how to get average results. And here's the kicker. I think most people can figure out how to get average results back in the 5th grade. You don't need a finance degree for that. Munger even jokes that if Buffett's way of investing were taught properly, you could cover it in a 1-week course, and then all the finance professors would be out of a job. Pushpin key takeaways. Let's break it down into a few simple points. Diversification is not a universal rule. It's smart for people who don't know how to analyze businesses. But for those who do, it can actually hurt performance. There aren't that many amazing companies. Maybe 5 to 10 you can truly understand. Putting money into your 30th best idea instead of adding to your best one is a mistake. Great fortunes come from concentration, not dilution. History proves it. Think Walmart, Amazon, Coca-Cola, not mutual funds full of 50 stocks. Modern finance theory is often out of touch. The math might be correct, but the logic doesn't help you beat the market. It teaches how to be average, not how to win. If you are an average investor and don't want to dig into company balance sheets and earnings calls, then yes, owning a broadly diversified index fund like the S&P 500 is still one of the safest and smartest moves you can make. But if you're someone who studies businesses, understands their economics, competitive edge, and long-term potential, then don't be afraid to go big on your best ideas. That's what Buffett and Munger have done for decades, and it's worked out pretty well for them. Make sure you subscribe our channel. Thanks for watching.